Hello, everyone. This is Dawn Weary with Chief Outsiders. Today, we're going to talk about how to adapt and thrive when your markets are shifting. I'm joined by 4 colleagues. Paul Sparrow is going to talk about how we understand where we're at in the business cycle and share that tool about assessing the stage and how it can shape the way you think about how you grow. And then we're going to hear from 3 colleagues, Dave McIntosh, Per Ostrom, and Jen Appy, who are going to share practical examples from businesses they've worked with, including our own. Welcome, everyone. So before we step into that, I do want to talk about why this matters. So what you can see here is markets and buying processes are changing fast. They always are, but the pace of change feels faster than usual right now. AI, market uncertainty, buyer behaviors, technologies are all changing. Here I've picked a few stats, but frankly, I could pull thousands of stats to talk about what's changing in the market. But let's just go over a couple that I pulled. Buyers are changing. 44% of large million-dollar purchases right now are led by millennials who decide things 41% faster than boomers. So if you're seeing millennials change, you're not alone, or buyers change. The buying journey is changing. 67% of B2B buyers prefer not to talk to a rep, and I've actually seen stats even higher than that. And 45% of buyers used AI during their last purchase. Almost half of buyers are using AI. And AI is accelerating. So 20 to 50% faster time to market when AI is used, and AI capacity is doubling every few months. So basically, the implication is markets are changing, and if you're not adjusting, you'll fall behind. So that's why we want to talk today and give some tips about how to be on top of your market so you can be adapting quickly. Now, before we bring Paul on, I want to quickly set the stage for one of the tools he's going to reference, rates of change. At Chief Outsiders, we use rates of change to understand where a business, ours or our clients, is in the business cycle. That matters because your business or your market may not be moving the same way as the broader economy. And tracking rates of change can help you see early signs of a shift before you feel it in traditional metrics like revenue. So what Paul's going to talk about are 2 specific measures, the 3-12 and the 12-12 rates of change. In simple terms, they compare your most recent performance to the same period a year ago. The 3-12 is the most recent 3-month period versus 3 months of the same 3 months the previous year. And the 12-12 compares the most recent 12 months to the same period a year ago. So the 12-12 gives you a broad annual trend. That helps you identify which of 4 business cycles you're in. If your 12-12 is negative, meaning you're behind last year, but the trend's improving, you're in recovery. Things may be down, but the trend's getting better. If your 12-12 is positive and rising, you're in accelerating growth. That's the phase we all love to be in. You're ahead of last year and the growth rate's strong. If your 12-12 is positive, which means you're ahead of last year, but the trend's declining, you're in slowing growth. That may feel good right now, but it can be an early warning momentum's weakening. And if your 12-12 is negative and declining, you're in recession. So the 12-12 helps you understand which phase of the cycle you're in today. But let's layer on the 3-12. That compares the most recent 3-month period to the same period a year ago. It tends to show changes in momentum before they fully show up in your 12-12, so it's more like a leading indicator. And what's important isn't just the numbers there, but the relationship between them. So if your 3-12, your leading indicator, crosses above your 12-12, that's an early sign things are starting to improve. But when your 3-12 falls below your 12-12, it's an early sign momentum may be weakening and your annual trend may follow. So that's a lot of information, and our goal is not to make you an expert on rates of change today, but to show you how this type of analysis can help you see potential shifts in your business cycle before they fully show up in your usual revenue or other financial numbers. And that matters because one of the biggest parts of responding to a changing market is seeing the change early enough to act. So that's what Paul's going to help us talk about today, how looking at trends like these can help companies see not just where they are today, but what's coming next so they can respond with confidence. So without further ado, let me pass it over to Paul.
Thanks, Dawn. Uh, I couldn't agree with you more. The markets are shifting, and so are businesses. Businesses are shifting along with the market. Now, I talk to a lot of business owners and executives, and I typically I'll ask, "How's your business doing?" And what I'll hear is what I call snapshot data. Snapshot data. An example of that is, well, last year we did X amount, X percent over the year before, and so forth. And in and of itself, there's nothing wrong with snapshot data, but it's limiting. It's just a finite shot of time, really. And so, what I recommend is using rates of change to understand how your business is shifting. Okay. And rates of change apply to all businesses, even seasonal businesses. If your business has big spikes in the fourth quarter, second quarter, you might go, looking at this, it doesn't apply to me. And that's not true. What you get through rates of change is a solid view of trending. You can see if your business is growing or contracting. So the seasonality of your business gets neutralized because you're looking at a period of time compared to the previous year. So applying rates of change gives you deeper insight on the shifting markets. Now, we've got a graphed out version of a company. This is a real company we're going to show you here. And what are you looking at? Well, you're looking at two lines, one in orange, one in blue. Those are rates of change. The orange line is called the 312. It's the leading indicator. And the 1212, the blue line, is the lagging indicator. Now, your point of reference in looking at this chart is down at the bottom. You see that red line? That's the zero growth line. So, and up the left-hand column is, the left-hand side rather, is percentage of growth either above the line or retraction of growth below the line. And moving to the next slide, anything above that zero growth line is favorable, and anything below is less than favorable. The relationship, and next slide, please. The relationship between the 312 and the 1212 is undeniable. All right. And when you look at it, look at the orange line and then look just to the right at the blue line. And you can see how that blue line, it's not a perfect mirroring, but the blue line follows that orange line. So orange being leading, 12 being the lag. Next slide. I've got one final orientation point for you, and that is what we call checking points. A checking point is simply when the lines cross, and that indicates a potential trend change. So what the arrow is pointing at there is an example of a negative checking point. That's where the 312 is heading down, crosses the 1212, and continues heading down. That's a negative checking point. And the next slide shows an example of a positive checking point, simply the opposite. It's the 1212 heading up, crossing the 312, and moving forward. Okay. Now, one thing that I'll say about the two lines, the 312 and the 1212, there's a relationship between those two, as I mentioned, and there's a lag between those two. So understanding that lag is really important for your business. It varies from business to business, but on average, I often see between 3 and 6 months. And just looking at the example of this positive checking point, you might look at it and go, if this is your business, and go, oh, our business is growing. It's time to invest in the growth of the business. That's a great instinct. You don't want to do that too soon because there's a lot of volatility in that 312. So my advice is to simply wait 2 or 3 months until, wait until the 1212 follows and mimics that growth trend, and then wait 2 or 3 months. And at that point, if it holds, you've got a viable change in your business phase. Final slide I'll share with you here is simply to say, the rate of change is very helpful in understanding the direction in which your business is moving. and using them properly will help you know which business phase you're in. These are the 4 business phases. Your business right now today is in one of these, and it is likely trending distinctly towards another. So using this properly is going to help you make really good strategic decisions. So that will help you thrive in shifting markets.
Great. Thank you, Paul. Normally, I wait and ask the questions at the end, but we had one come in. How hard is it to calculate the rates of change, Paul?
Oh, that's a great question. Thanks for sharing that one, Dawn. It's incredibly easy. Now, you need a couple of tools to help you do that. I have an Excel spreadsheet that all you have to do is load in your company data, and it will actually graph it out for you. So how long does it take to do that? If you do it by hand, for about 5 years worth of data, it'll take you between 30 and 60 minutes. But you can use AI. You can actually plug it in AI, which will literally take seconds. So it's really easy.
Terrific. Thank you, Paul. So now we're going to move into some practical applications, and we're going to start with Dave.
Well, thanks. I think rates of change is a great tee up there, Paul, because rates of change certainly provides that foresight and clarity on when to invest in the next chapter or evolution of your business. And I know you and I collaborated on a client that was a mid-market facility services company, and one of the things that we saw there is that when we went in to really diagnose that business, and before we even got to diagnose it, they had seen on their rates of change analysis from the work that you had done that it was a good opportunity to look at the future. And so I think we got a couple slides on this if we can pull them up. And so one of the things that we did is first we went and we diagnosed this, and it was really a third generation business. It didn't have any sales or marketing, no revenue engine. And one of the biggest things that they were really struggling with was this concept of quality versus quantity. And so the big move that we ended up addressing here was ultimately to redefine the ICP. When we diagnosed the business, one of the things that we saw is that they had over 100 clients with an average account value of around $200,000. But then one of the things that we noticed too is that their top 20 clients were 5 times that. And so it really kind of the big move here was diagnosing or redefining that ICP, and then coming up with an anchor account strategy in which they could grow from, and ultimately building that revenue engine and hiring in a leader to drive that business forward. What did that provide them? Ultimately, it provided them optionality. It gave them optionality in terms of what that next chapter might look like. And ultimately, they sold a majority of stake in their business to PE at the beginning part of this year. So I think that was one piece. The other piece is that post-deal, it really sped up that delivering deal value that the private equity firm is really looking for as they begin to embark on the next chapter of that business. So the key takeaway on all of this, and this is the idea I want to leave everybody with, is on the next slide here. And that key takeaway is ultimately the revenue engine that you build before you need it is much more worth the one you scramble to build after the fact. And so what this boils down to is that the rates of change analysis, that's the foresight. And foresight is that tremendous asset. Once you have that, then number 2 is ICP will trump the volume all day long. If we get the ICP right, good things will happen. And then ultimately, when you have the right engine in place, that will not only help drive multiples in the business pre-liquidity event, but also it will speed things up after the case.
So, Dave, that's terrific. And a couple of things that I just thought were great. I love this takeaway, right? Always better to be ahead of the change, not chasing it. But I also love the fact that you talked about your ideal client profile. Buyers are changing. We talked about that in slide 1. And often we see companies that are hanging on to an old ICP. So thinking about how might your ICP change as your buyers change is so important. So terrific. All right. So now we're going to move on to another example through Pear. Pear, why don't you take us through that?
Yeah, thank you. I have used this methodology probably with a dozen clients since I joined Chief Outsiders, and I find it very, very, very useful. All you need really is monthly sales data, as many years back as you can, and once you plot it out and you sit down and you talk to the CEO, you talk to the senior leadership, they will remember certain things, so they can associate the curves and the inflection points with actual events in the business. So, okay, yeah, I remember that's when we did this, or that's when the costs went up, or that's when we lost that big, really big customer. So you immediately kind of show them that it's an analytical tool, but it's not, from the ivory tower. It's building on their actual business experience, and that creates an element and a level of trust right away that makes the tool, I think, particularly helpful. So to build on Dave, really that little lag between when the curve starts, the 312 curve starts up or starts down, that lag until the 1212 curve follows, that's really the space, the grace that you have to do something, to kind of look around the corner and get prepared for what's coming next. So usually what I suggest, if there's a downturn coming, don't wait, but start activating your selling efforts. Make sure that you are the prepared vendor of your most valuable customers, right? Your ICPs. Don't skimp on market communication. Now is the time to get your name out there, right? Don't skip that trade show. Be there in force, fly your colors and show them that you're a market leader. And on the other hand, costs that are not obviously visible to customers, there's nothing wrong with battening down the hatches, right? So do whatever you can to keep costs under control. And that can be things like travel, like lodging, those kinds of expenses. But don't skimp on the marketing and the selling side. That really doesn't work. On the other hand, when the curves are crossing in the other direction, right, and things are moving up, now is the time to push the accelerator, right? And if you start, 2 or 3 months before your competitors, you're in a much better place when demand really starts taking off, right? So when you're in an upturn, you really got to look at things like sales coverage. Do I have good reps? Do I have good BDRs? Do I have my distribution structure in place? Do I have my outside salespeople up and ready to go and trained? Now is the time to launch new products that you might have been, keeping in your back pocket. And it's also time to secure inventory, right? Because if things indeed are looking up, then there's going to be a competition at the other end of the business for inputs. So those are our typical examples that I do when I work with companies.
Pear, that's great. And what I really loved about it was talking about the fact that data reflects their real experience, helps you look around the corner, just like Dave talked about, but also helps you do things based on data, not instinct. So you're not hiding or being paralyzed by your changing market. And it wasn't just sales and marketing. I heard you pop inventory in there, right? So knowing what to do across all parts of your business to be ahead of the game, so important. So I'm actually going to take another one of the questions real quick. And this is for both Paul and Pear. But you mentioned tracking, I believe you mentioned revenue, Pear. Is that the only thing that you would track with a 312, 12, 12? Or is it flexible in terms of what type of data you'd use?
There are different things you can track. You can track different levels and different parts of the company. You can track individual salespeople. You can track a branch's performance. You can track a division. You can track a country. Paul, you might have additional examples.
Yeah, I always recommend revenue is the starting point, but revenue for the overall company doesn't give you the full picture, but you got to start there. And then I call it follow your nose. So, I wonder what else should we look at that would give us this, that would explain this revenue trend? Well, lines of business, products, services, geographies, locations, pairs right. You can, and we have a client who actually we measured their sales reps results. You can measure literally anything, profitability, EBITDA. The list goes on. You can look at, I had a prospect the other day. We talked about sessions. They serve, they're in the healthcare business, and how many sessions that was important to them. So the point being, follow your nose. What are the things that would help us understand this growth or recessionary trend that would drive our business? And when you figure that out, you'll end up with a dashboard of rates of change somewhere, depending on the complexity of your business, between maybe 6 and 12 rates of change you can put on your dashboard. So I strongly recommend going to that next level.
Perfect. Okay. So far, we've focused a lot on rates of change. Personally, it's something we track here at Chief Outsiders, and we've seen lots of value for clients. But that is not the only thing that we need to be thinking about when it comes to anticipating where we're going. So one of our foundations is the growth gears. You can learn more about it at chiefoutsiders.com. But Jen's going to talk a little bit about that. And one of the biggest changes that's happening right now in the market is AI. We hear about it all the time. So Jen is going to switch us off of rates of change and talk about that.
Thank you, Don. Yeah, at Chief Outsiders, we use the growth gears to accelerate growth for our clients, from driving deeper insights to developing effective strategies and more efficient execution. And a few years back, we built our own AI platform to harness the power of AI tools, not only to provide deliverables faster, but to harness the experience gained through thousands of successful engagements to gain better insights to power growth for small to mid-sized businesses, both growing the top line as well as growing the bottom line. And so AI can be used to do a lot of the things that Paul and Dave and Per talked about, especially that rates of change analysis and creating that one-page executive summary. That's something that we can do with our platform. Dave also talked about pulling competitor data and creating profiles and personas. We can do that with our platform as well. And if we could just bring up the slide, I'll show you the full list of examples of things that we've used to help our clients. In the gray boxes, the analysis, the competitive analysis, being able to pull competitor data, being able to develop those profiles, as Dave mentioned, but also to help us really think about smart segmentation, to build lists and enrich those lists, and to develop better, more effective messaging. And finally, in the execution stage, being able to be hyper relevant in our outreach and using AI agents as kind of that marketing engine in order to scale, as well as using AI for staff onboarding and training. But what I wanted to highlight was what I put at the tops of these boxes in yellow. And these are the things that we're doing with our clients that's really helping them to pull ahead in these shifting markets, to pull ahead of the competitive landscape. And in the inside space, it's really thinking about how to embed AI into their product or service in order to create a differentiated offering that serves their customers better. In the middle, it's discovering latent demand, which is finding hidden customers who are not looking. I think the stat is that 95% of your potential target market doesn't realize they have a problem yet. And so therefore, if you can harness 15% of that 95%, you might be gaining customers where your competitors are not looking. So it's really trying to convert that that latent demand that is the opportunity that we can uncover with AI. And then finally, developing inbound sales agents that can qualify faster, that can qualify better, and deliver more qualified leads to the sales process, that qualified leads that close faster. That's really making a difference on the sales side. So one example that I have of finding hidden customers who are not looking is using public data in order to discover things that might be changing for prospective customers. Things like regulations, compliance, things like let's say there's a new compliance for energy utilities, right, that they have to follow, or maybe there's a new HIPAA requirement or a new security compliance requirement. These are things that might dramatically shift the landscape that a company finds itself. And if we know that these companies are going to be affected and we know how to help them through that challenge, that is the way to find a hidden customer who is not looking. Fall protection equipment, right? For companies who have experienced fall incidents as listed in the public OSHA incident database, we might be able to contact them and offer them a free fall protection audit. So these are things that we can do with AI faster and better than we ever could before. And this is what companies are doing now in order to really change the trajectory of growth for their companies.
Jen, that's fabulous. I love thinking about how change isn't scary and change is actually opportunity in this case with AI. And
absolutely,
that idea that you've got latent demand out there, right? People don't even know they need your services, and being able to use the tools that are coming to find and deliver leads, so important in a changing market. So terrific. So we're going to move on to questions, and we have a few of them, but I hope that what everybody has seen so far is that, yes, markets are changing. If you can be ahead of it, and if you can think about how to use new tools like AI to help you reach new customers, you actually are ahead of your competition and ahead of the game. So let me go ahead and take a question. I'm going to start with one for Jen. If we're feeling behind on AI, as you said, people are out doing things. If we're not doing it right now, what should we be thinking about?
If you're feeling overwhelmed, you're not alone. I think everyone, even those who are implementing AI on a daily basis, feels like there's always something new around the corner. So don't despair if you feel overwhelmed. But I think that the thing to do is to focus on the one thing that you could be doing next in order to make a difference in your business. And whether that's implementing a new AI agent, or whether that's using it for a new process, or creating a new automation, just focus on that one thing and then the next after that. And I think that's the way to get through the overwhelm. But if you're just getting started and you haven't implemented anything yet, what I've been talking about is companies who have taken this as an opportunity and moved forward. But you also have to be careful of defending your company and defending the market share that you have, and really think about how buyer search is shifting and how that's going to impact your company. And it's a defensive move to go out there and search for your own company, play the role of your prospective client, and search for yourself in the different engines. Think about what they might be thinking about, and then determine what that means for your business, right? What the implications are in terms of the content you need to write, or the events that you need to be at, or the way that you show up in the market space that the answer engines are paying attention to. So at least do that defensive move to figure out how you rank vis-a-vis your competition, and then slowly move ahead to taking advantage of some of those hidden opportunities.
Dawn, one thing that I would add to that is the Chief Outsider's AI maturity assessment. That's a really valuable tool to help anybody get a little insight into where are we and what do we need to focus on.
Yep, absolutely. And so important right now. I've heard estimates that 35-40% of search traffic has declined or is gone in the new AI search model for many markets. So if you're losing leads because you're not getting your web leads, that might be part of the culprit. So terrific. Okay. I'm going to move us over to a series of questions about the rates of change. So let's start with Paul. A question came in that I think you'd be good at. You've done a lot of rates of change analyses for customers. Is there one that was a surprise where it actually told them something different than they thought was happening in the market, and what did they do as a result?
Oh yeah, yes. There's not just one. That's pretty normal. I can think of a business that we worked with recently. They had 5 lines of business, and they didn't really understand which ones were driving and which ones were dragging. The smaller part of the business, well, small is a relative term, big enough, was founded by the grandfather of the CEO. And there was great reverence to that line of business because he was well respected in the community, and they were a great company and respected in the community. And so they had this loyalty to that line of business. Well, when you looked at it, holy mackerel, it was in a long, and you notice how long I said long, economic recession. And when I presented it to them, they went, wow, they knew it. They sensed it. They had no idea what a strong drag it was on the overall bottom line.
Wow. Such great insight to know that.
It's so easy. It's so easy.
Perfect. Pear, why don't you take this one? What pricing actions should people take when inputs are more costly or confusing and it's just harder to do?
Yeah, I get this question almost every day when I work with clients now because of the general, run up in costs. It's not just fuel that drives transportation costs, but it's a lot of other, raw materials from manufacturing companies that are getting more expensive. So the first thing is what you should always be doing. You should always be working on your continuous improvement, right? So fire up those green belts and black belts and drive costs out of your business, right? Be more efficient in your processes. But if you're buying things like steel or aluminum, if you can, lock in prices, they might look high today, but they're going to be even higher tomorrow, right? So buy on contracts and try to lock it in. Pool your purchases with somebody else, right? To gain more purchasing power. There's lots of purchasing groups out there that kind of support each other. And then, of course, control costs in general, right? So if there's a more energy efficient way of doing something, then that's the way to do it. And, at the end of the day, a company's duty is to protect the margins, right? And to be profitable. So when nothing else works, you're going to have to pass some of these costs through, right? So price increases are a fact of life. And nobody can ask any company to absorb it all by themselves. So those are usually the 3 pieces of advice that I give.
Yeah, very interesting. I remember, a little over a year ago when tariffs were creating a lot of uncertainty, talking about that in some of our content about the actions you should take. Very similar.
Mm-hmm.
So, great. Let me pick another question. Dave, I'm going to pick on you this time. How do you think about revenue team, the compensation models for your revenue team when the market is shifting? So their job is shifting.
Yeah, it's a great question because certainly markets are always going to shift up and down, and I think one of the things is that when the market is shifting, is that really ties into partly employee engagement, and specifically in the revenue world, how current is the compensation plan? Is that compensation plan tied to a model of how the business was performing in a hot market? if the business is now in a soft market and everything is based upon those high volumes and those high conditions, that might be something that warrants adjusting there. And it's really looking at that and saying, hey, does our compensation plan maybe need to reward something different? Is it attracting the right behaviors or driving the right behaviors in the business? One of the things I see a lot of times, quality versus quantity. A lot of times in hot markets, everybody's going after volume, but maybe in a softer market, it is something where you're after the quality. So conversion rate might be something that a business would look at in terms of compensation for their sales organization.
That's a great point, is that depending on the market you're in, what you should go after and how you reward so that you get the action you're looking for. Absolutely. Okay. I think we've got time for one more question. So I am going to pick one and open it to everyone, even myself maybe. Other than rates of change, what else can companies be doing to watch and anticipate what's going on in their markets? Anyone got thoughts?
I can go. I think the AI has given us the opportunity to very simply and inexpensively build agents that can keep track of things. So I have clients now that keep track of competitors' imports, how much they import of different raw materials, which kind of helps them understand how they are doing and what the product performance is going to be. There's other things you can very, very easily track as well that otherwise would take a little bit of effort. But things like import levels, like pricing, like new products, all of those are much easier to kind of keep on top of using different AI tools.
Hey, Don, I'll add to that. I would caution companies from getting too wrapped up in macroeconomic data unless they do business from sea to shining sea. So I live in Charleston, South Carolina, so I'll pick on Charleston. If your business, if you do business in Charleston and Detroit, I know that seems remote,
But okay.
but I'm going to Detroit in a couple of days. Had Detroit on my mind. But if that's where your business is, you have two distinct footprints where you do business. Well, you need the microeconomic data of that area. Okay. So if you're in construction, you need to understand the economics of the construction world in Charleston and in Detroit. I assure you, they are two uniquely different marketplaces. And if you're building strategies holistically, it's thinking of the two as one, that's probably a very flawed strategic growth plan.
Great point.
I'll add one, Don, and this might be a little bit tactical, but because everyone's doing research using AI tools, and that's in many cases, I think 71% of people start in AI when they're doing research. You're going to have to think about how your website displays what you want potential buyers to know.
Mm-hmm.
So how you structure your website, how you tag your website, what data you put on your website, that's going to make you discoverable to prospective buyers. And so thinking about that and how you're surfacing data on your own website is going to be very, very important. It's a new class of user, the AI agent.
Absolutely.
Yeah. One other kind of observation that I would offer up in a shifting market to monitor. Certainly, people are monitoring external conditions and competitors and a lot of things that we're talking about. But I also think it's an opportunity as we look inside the business, whether it's through rates of change or other things like that. But ultimately, it's controlling what we can control in the speed of execution. And so I think that tools like AI certainly allow and help provide that tool to drive speed of execution. Because when the markets shift, everybody's scrambling around. And so to the extent that you can utilize those tools effectively to drive at what you can control in the shifting market, then you'll have a leg up.
Perfect.
Good.
All right. So I'm going to go ahead and wrap us up. And I think what Dave said is a perfect segue into my key takeaway, which is that in a shifting market, the biggest thing that gives you power and control is to be thinking ahead, looking ahead, and trying to understand where you're heading. So I would like to thank all our panelists. And also, if you enjoyed this conversation, we do quarterly webinars. Just go to our website, chiefoutsiders.com, to sign up for the next one. Thanks, everybody.
Thank you.